Hi everyone, Alex here just with another quick update. Now it's always interesting and entertaining to read the various market forecasts and predictions from experts in the media at the start of each year. There is absolutely no shortage of these market experts willing to make predictions about where the market or even individual shares are going to be next. But if 2020 has taught us anything, it is that little attention should be paid to anybody who thinks they can accurately foresee the future. In market forecasts for 2020, a global pandemic and the worst recession since the 1930s weren't high on everyone's list of threats. And even if you could forecast news and events like the pandemic, you would still have to work out how markets will react. The truth is, no one can predict the future with any consistency. The risks that have the biggest impact on markets tend to be those that nobody saw coming. That's why, as an investor, a long-term focus and discipline are so important. All of this is not to downplay the current uncertainties or to forecast another bumper year for 2021, but rather to advise caution when reading media and market commentary about what the coming year might hold. We have already seen heightened volatility in markets in 2021. No one would have predicted a small company in the US by the name of GameStop would be causing so much disruption to markets and be dominating the news over the past month. And just quickly on that point, many of you may be seeing in the news that some hedge funds are losing a significant amount of money given their exposure to GameStop. Some have lost above 50% in the month of January alone. For those of you that don't know, a hedge fund is simply an alternative type of investment that pools investors' money together and uses different investment strategies with the aim of outperforming the market or achieving higher returns. Each fund has its own strategy, but these strategies tend to include not only picking stocks with the aim of profiting from companies that increase in value over time, but also profiting from share prices dropping in value. And this is commonly known as shorting a stock. They can also use borrowed money to enhance returns, and they use various derivative products to manage their investment risks. I just want to reassure and reiterate to our clients, which we manage a portfolio on their behalf, that we simply do not invest in hedge funds. We view these types of investments as a bit of a black box, and we do not invest in them given their lack of transparency. Many funds state the reason for their lack of transparency is due to not wanting to give away their trading secrets and have their perceived advantages eroded. We do not believe that anyone should invest in a product that they do not understand. Hedge funds can also lack liquidity. Liquidity simply means how easily it is for an investment to be bought and sold, and it can be harder to access your investment in many of these hedge funds. And another reason is fees. Hedge fund fees can be incredibly high. It is not uncommon to see fees amounting to 2% of assets and 20% of profits. Hedge funds fees are not only expensive, but they tend to be extremely complex, as they include management fees, performance fees, hurdle rates, early redemption and withdrawal fees. While some hedge funds have performed quite well, research has shown that the vast majority have often underperformed the market in both rising and declining markets. All the while, they charge an exorbitant fee to do so. For our investment philosophy, we value transparency, liquidity, and low fees, and we employ strategies we can understand and effectively monitor. Moving back now to markets and what to expect for 2021, what you can be sure of is events will occur and news will break. Some of that news will be largely anticipated and priced into markets. Other news will be unexpected and will move share prices. There are a number of events that could move markets this year, but there is little point in speculating about any of them. as a long-term investor at least. With that in mind, how can we think about the future? A starting point is to distinguish short-term noise from your long-term goals. 2020 has showed that while market volatility can be nerve-wracking, changing a long-term investment strategy in response to short-term declines can prove far more harmful than helpful. What you should be focused on is having an investment portfolio designed for your investment goals and your risk appetite and time horizon, and to manage risk through diversification and to rebalance the portfolio as markets change and as your circumstances evolve. Now, finally, we were busy over the Christmas and New Year period launching our new website, and we've included a link to the new site in the post, so we encourage you to check it out. As always, we would appreciate your feedback on content that you'd like to see in the community, and we'll be sure to incorporate that in future posts. Thanks.